Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
An investment condo in central Osaka costs about 43% less than the same kind of unit in central Tokyo, and it yields more. So why does almost every foreign investor still default to Tokyo? Let's look at the actual numbers. Tokyo is Japan's safe, liquid, globally recognized real estate market. Osaka is the value alternative most overseas investors never seriously look at. We're putting them head-to-head using the same data source, so the comparison is apples to apples. All figures here use the same Kenbiya quarterly market data behind our 5-city comparison video, so nothing here is cherry-picked to make one city look better. A compact investment condo in Minato Ward, central Tokyo, currently averages around 36,870,000 yen, about $228,297. The equivalent unit in Shuo Ward, central Osaka, averages around 21,150,000 yen, about $130,960. That's a real gap of 42.6%, not a rounding error. Yield tells a similar story. Osaka's surface rental yield sits around 5.73%, compared to 5.22% in Tokyo. Lower entry price, higher yield. On paper, Osaka wins both sides of the equation. In monthly terms, that yield implies roughly 100,991 yen in rent for the Osaka unit versus 160,384 yen for the Tokyo one, on a property costing over 40% less to buy. Both markets have been rising. Over the past 3 years, Tokyo condo prices in this category climbed about 61%, while Osaka rose about 54%. Tokyo's climb has actually been steeper. So why does the price gap exist at all if Osaka is catching up? Mostly reputation and liquidity. Tokyo is the default answer for anyone Googling Japan real estate, and capital tends to flow toward the most familiar name first. But reputation isn't the only thing that moves prices. Osaka has 3 concrete catalysts working in its favor right now that Tokyo simply doesn't have. The biggest one, Japan's first legal casino integrated resort, is being built in Osaka, not Tokyo. MGM Osaka, on the artificial island of Yumeshima, is a roughly 1.5 trillion yen project, one of the largest single private developments in Japanese history. It broke ground in 2025 and is scheduled to open around 2030. The plan includes a 2,500-room hotel complex, a large casino floor, and major convention space. MGM's own leadership confirmed roughly $450 million in new equity committed in 2026 alone, and that's before counting debt financing. Including the non-gaming leisure and entertainment facilities planned around it, total investment on Yumeshima is projected near $15.16 billion, an entirely new tourism and entertainment district being built from scratch. Yumeshima isn't a blank slate either. It just finished hosting the 2025 World Expo, which brought new bridges, transit links, and international attention to the site before a single shovel went into the casino resort itself. The second catalyst is downtown. Green Osaka, the redevelopment of the old Umekita freight yard known as Umekita, partially opened with a large new park and mixed-use towers, with full completion targeted for 2027. It's already reshaping Osaka's most central business district. The market is already responding. Osaka's commercial real estate investment hit a record 1.2 trillion yen in 2024, up 107% year-over-year, the first time it's crossed that threshold. A $10 billion class casino resort and a major downtown redevelopment landing in the same city, at the same time, is not something Tokyo has waiting in the wings right now. Now let's look at demand. Population growth is the underlying driver of long-term rental demand in any city. Tokyo's population is projected at about 10,316,210 in 2026, up roughly 99,525 in the past year, a 0.97% annual growth rate. Tokyo remains the only prefecture in Japan still growing at all. Net in-migration into Greater Tokyo runs roughly 80,000 to 100,000 people a year, domestic workers and international residents combined. Osaka's population is smaller and growing more slowly in absolute terms, about 2,828,297 people in 2026, up 12,791 in the past year, a 0.45% growth rate. On raw population growth, Tokyo wins clearly. But look specifically at foreign residents, the group most likely to rent rather than buy, and Osaka's story changes. Over 145,000 registered foreign residents now live in Osaka City. 10 years ago, foreign residents were about 4% of Osaka's population. Today it's about 6%, roughly a 46% increase since 2013, far outpacing the city's overall population growth. The largest groups come from Korea, China, and Vietnam, reflecting Osaka's role as a regional hub for the rest of Asia, helped by Kansai Airport's short flight times to Seoul, Shanghai, and Taipei. On rent, Tokyo is currently the hotter market. Rents across the 23 wards rose about 6.5% year-over-year as of early 2026, with the average one-bedroom now around 195,000 yen a month. Central ward occupancy is running around 96.0% to 96.5%, essentially full, which is part of what's pushing rents up so fast. Osaka's rent growth has been steadier rather than explosive, a 2.6% compound annual growth rate since 2019. Slower, but also less exposed to a sudden cooldown if Tokyo's current pace turns out to be a spike. Financing rules don't change between the two cities. Non-permanent resident foreigners can typically access variable rate mortgages around 0.8 to 1.4%, and there's no restriction on foreign property ownership anywhere in Japan, Osaka included. There's also a practical angle. The same $228,297 that buys one unit in central Tokyo could buy roughly 1.5 comparable units in central Osaka, letting an investor split capital across two markets instead of concentrating it all in one. So who actually wins? On pure entry price and yield, Osaka is ahead today. On growth certainty, market depth, and global liquidity, Tokyo is still ahead. Tokyo's risk is really a pricing risk. You're paying a premium for safety and liquidity, and today's hot rent growth may not be permanent. If Tokyo rents cool off, that premium gets harder to justify. Osaka's risk is catalyst dependency. The investment case leans heavily on the IR and Umekita actually delivering on schedule. Casino Resort projects globally have a track record of delays, and a slip to 2031 or 2032 would push the payoff further out. Osaka is also a shallower market than Tokyo. If you need to exit quickly, there are simply fewer buyers competing for the same property than there would be in central Tokyo. Tokyo fits investors who prioritize capital preservation and easy resale over maximizing yield, and who are comfortable paying a premium for that certainty. Osaka fits investors comfortable underwriting a catalyst-driven growth story, who want a lower entry price, a higher starting yield, and are willing to accept thinner liquidity while the IR and Umekita projects play out over the next several years. To recap, Osaka is about 43% cheaper to enter than Tokyo, yields 5.73% versus 5.22%, and has a roughly $15.16 billion casino resort and a major downtown redevelopment landing by 2030. Tokyo has faster current rent growth, a much larger population base, and unmatched liquidity. Neither city is objectively better. Tokyo is the safer, more liquid bet at a premium price. Osaka is the higher yield, catalyst-driven bet at a discount, with more execution risk attached to it. That's the real data behind Japan's two biggest real estate markets, head-to-head. Subscribe for more data-driven breakdowns of Japan's real estate market.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.